What's up, you guys? Welcome back to the Average Joe Investor channel. So it's finally happened. SCHD has had its annual reconstitution for 2024, and a lot of videos have already been posted. I actually made a concerted choice this year to wait and let it marinate a little bit, take some time to look at the differences, do a lot of the deep dive into the underlying stocks, what was added, what was taken away, to see what are my big key takeaways. What are the big differences this year? What do you as Average Joe investors need to know about the difference in SCHD in 2024? So here are my 5 key takeaways. Let's dive in. Okay, so my first key point here is, in case you didn't notice, SCHD is a dividend ETF. I don't mean to insult your intelligence when I say that, but I see a lot of people freaking out that AVGO, AVGO, which is Broadcom, is gone. And it makes sense. I'm not sure why people are freaking out here. Here's a look at the 1-year chart for Broadcom. Back in the beginning of the year, it was trading around $400, $500, $600 per share. And at the end of the year, it was trading at nearly $1,200 per share, which is pretty insane. So if you owned AVGO, great. You made a lot of money. But it also took AVGO from a yield in the 2s down to 1.62%, which is not good. Yeah, technically it's a dividend stock, but it's not a real good dividend stock. It's definitely more capital growth focused and less about dividend yield. Here's a brief overview, by the way, of the additions and the subtractions for SCHD in 2024. We'll dive into this and talk a little bit more about it soon. But AVGO was the top spot in SCHD in 2023, and it's gone now in 2024 because of the fact that its yield is so low. But we don't own SCHD for capital growth. We own it for the balance between growth and the dividend income, or more weighted on the dividend income. If you really want capital growth, don't own SCHD. Go own VIG from Vanguard. They're much more capital growth focused, much lower on the dividend yield. And of course, you could also go purchase AVGO yourself and own it as an individual holding. So that was my first key takeaway here. People freaking out about AVGO being gone, I'm cool with it. I think that it actually benefits SCHD as a whole for the reason why people own SCHD, the dividend and dividend growth. My second key takeaway, safety first. Remember, SCHD's reconstitution is based on an algorithm. There is no asset manager making decisions here. It's all algorithmically based. Take a look here at the payout ratio based on free cash flow. A lot of the stocks that were dropped were pushing up against very high thresholds or just blowing past them here in the red. Whereas the stocks that were added, there were only 2 here in the red, everything else was in the green. My key takeaway number 3 was to see the positive changes in the weighted yield and the dividend growth rate. Contrary to what I've seen other people say, they think that the yield is actually going to go up. I'm not sure it's going to. When you look at the actual weightings, the year-end weightings for SCHD compared to where we're at with the new stock, we can see that we lost a weighted yield of 0.65%. Okay, I took the actual yield and the actual weighting in SCHD previously to figure out how much we lost, 0.65%, and how much we gained with the new stocks, 0.38%. So I don't think that right out of the gate we're going to see an increase in the yield, but we're seeing a lot of positive changes to SCHD in my opinion. Number 1 is the dividend growth rates. Look at all the stocks here that were dropped. Some of these, the ones that have numbers here in the year's consecutive dividend increases, are stocks that are in my monthly dividend stock spreadsheet, meaning that they've been raising their dividend now every single year for at least 5 consecutive years. If it's not on the spreadsheet, it doesn't have a 5-year growth history. Now, they could raise their dividend 1 year, wait a few years, then raise it again. That means it doesn't have a streak every year. You can see that in total, the stock, SCHD, dropped 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 of the stocks they dropped did not have a 5-year growth history. Okay, and they also dropped, like First American here, that only had a 2% growth rate in the most recent year. Then Kellanova right here had very poor dividend growth, and also right here 3M had poor growth as well. And then you look over here at the ones we added. Yeah, sure, we added 1, 2, 3, 4, 5, 6, 7, 8. They don't have a 5-year history, but we also added 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 that did have a 5+ year history. And a lot of these here, a lot of them had double-digit growth history over the past 1, 3, 5, and in some cases 10 years. This is a net gain, I think, for SCHD. Here's a look at the dividend growth rates historically for SCHD. Historically, it's one of their biggest benefits of owning SCHD, the double-digit compound annual growth rate of the dividend. 10.87 over the 10-year average every year, 11.8% over the past 5 years, 8.56% over the past 3 years, but look at the dividend growth rate over the trailing 12 months. I believe the actual number here, year over year, was actually 3%. That is a marked decrease from previous years. And I think that this change here that I mentioned, going back to the spreadsheet, this change in adding these dividend stocks with these really positive growth rates is a really big improvement. Okay, my key takeaway number 4 here is let's take a look at the significant change to the top 10 weighting. So we've got here 1, 2, 3, 4, 5. 5 or half of the stocks in the top 10 weighting at the end of 2023 are no longer in the top 10 weighting. The holdovers are AbbVie, Home Depot, Chevron, Cisco, and Texas Instruments. Coca-Cola, Verizon Wireless, Amgen, Merck, and Broadcom are no longer in the top 10 weighting. And in fact, Broadcom and Merck are gone completely, even though they were the top, one of the first and the third top holdings in the ETF last year. This year, they're both gone. And we added Bristol Myers Squibb. We went from nothing at all to having the number, I believe, 6 or number 7 spot in the top 10. All right, last big thing I wanted to take a look at here was the change in the overall sectors and SCHD. Now, SCHD has a rule based on their prospectus that no one sector can make up, I believe, more than 25% of the holdings. And we don't see that here. What we do see, though, is a shift in the sectors. You'll notice that from 2023 to 2024, financials went from 14 to 18. Energy went up from 10 to 13. Consumer staples stayed flat, 13 to 14. Consumer discretionary went up as well by 1 from 9 to 10. Communications stayed flat at 5. Materials stayed flat at 3%. Information technology, a big shift away, and that's partly because of the fact that we lost Avgo. But we definitely saw a significant drop from 17 to 10 there. Industrials dropped by 1, and then healthcare actually went down by 1 as well. And I think this bodes well for the idea that we might see a recession here this year. I don't know that for sure. I don't have a crystal ball, but I do think that a decrease in information technology from 17 to 10 bodes well to align more with a value-based holding as we potentially go into a recession. By the way, if you want access to this spreadsheet, happy to share it with you. All you got to do is join the Average Joe Investor Patreon community. There's a link down in the description below. You can access to just these spreadsheets and my monthly dividend stock spreadsheet. Or if you're interested more in generating cash flow, there's a few other tiers of the Patreon that you're going to see much more value out of. Link down in the description below. If we look at the top dividend stocks by weighted yield in the fund, we'll see that the top holdings here are Altria Group, MO, at a weighted yield of 0.30% or 0.299, followed by Verizon, then Pfizer, Bristol Myers Squibb, that new addition, Chevron, United Parcel Service or UPS, AbbVie, and then Amgen, Cisco, and Pepsi. A few other things I really liked about this adjustment is the inclusion of some higher quality dividend stocks, such as right here, ticker symbol CINF, Cincinnati Financial Corporation, has 64 consecutive years of raising their dividend. And they were not in the fund last year. They have really solid dividend growth right here and a really solid payout ratio based on free cash flow. Another one right here, C.H. Robinson Worldwide in the industrial sector of the economy, was not in the fund last year, is this year, has raised their dividend now for 25 consecutive years. Really stable dividend growth right here, and a really low payout ratio based on free cash flow. Same thing with Bristol Myers Squibb right here, 17 consecutive years of growth. And Hershey Foods right here, 14 years of consecutive growth. Really great dividend growth here as well from Hershey Foods. So the key takeaway here, as we look at the additions and subtractions here, the key takeaway that I see, I think this is a big, huge net positive for SCHD moving forward into 2024. They did a great job through their algorithms of filtering out stocks that are not as healthy, that have lower dividend quality metrics, and added a lot of dividend stocks that are positive. Hopefully you found some value in this video, guys. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.